Later.
Is it working? Okay. Yeah, this is for the 1 o'clock class. All right, so we are in chapter 10, finished chapter 9, and we're in chapter 10, which focuses on cash flows. So we looked at net present value, payback method, net present value, internal rate of return, and so we look at cash flows in the numerator and 1 plus K to the N in the denominator. And so what we're focusing on in this chapter, so we looked at those techniques, payback method, net present value, internal rate of return, and I gave you this information. All you had to do was plug it in. Now we're going to dive a little bit deeper into developing our cash flows. And then in chapter 11, our last chapter, we'll look at the cost of capital. Okay? All right, so question 1, what are incremental cash flows? Incremental cash flows. And these are the cash flows that go in the numerator. Okay? Just these cash flows. Hence the term incremental. These are cash flows that will only occur if you go ahead and do the project. Okay? And so the first thing that you're going to have to determine in a project when you're doing your analysis, your net present value, your internal rate of return, is what outflows do we actually include in the cash flow. Okay? And these would be your incremental cash flows. Okay? All right, question 2, how should opportunity costs be handled in a capital budgeting analysis? How should opportunity costs be handled? So an opportunity cost exists if an asset has an alternative use. If there's something else you can do with an asset, then you have an alternative cost. For example, if you have an empty office that you could sublease, then you must include the missed revenue from the sublease as a cost of using the office for a project. Okay? And this is something that a lot of people get wrong. Oh, we have some space here. It's empty. It's free. There's no cost to it. Untrue. If you could lease it. Now, if you've tried to lease it and nobody in the marketplace wants it, then you don't include the cost because there is no alternative use. But if you have a building or a piece of ground that you already own and you want to use it for a project and you think, well, I own it, it's free. No, it's not. You could sell that land, and so you have to include the cost in your analysis. All right, you always use the market value of the missed opportunity to quantify the value of that missed opportunity. So that's an important point too. Oh, I've got this piece of ground and I want to build a warehouse on it, and Dr. E says it's not free. Okay, I spent $100,000 for it 10 years ago. That's the cost. No, it's not. Mr. Shepard just said you use the market appraised value. That's what you could get. That's your opportunity cost. So that is the cost. The market value is the opportunity cost that you include. Okay? So as I say, for example, you bought a piece of land 10 years ago for $100,000. It's empty. You decide to build a plant on it. Is the land free? Is the missed opportunity $100,000? What if you could sell the land for $1 million? That's a cost of the project, $1 million. That's the missed opportunity cost. Okay? And that's included as a negative cash flow in your capital budgeting analysis. So I have lectures that are videoed, and the students are responsible. They have to submit notes, they have to fill in notes, they have to watch the videos, fill in notes. And then these are homework questions that come from those videos. So they're all reinforcing. Okay, so what are side effects and how are they handled in a capital budgeting analysis? Side effects. So side effects are, or sometimes called spillover effects, are consequences to other parts of your business that occur as a result of a new project. Consequences to other parts of your business. Side effects can be good. They can be good things. For example, they might lead consumers to buy other products that you sell. Okay? Mr. Shepherd talked about his horizontally and vertically integrated enterprise. There are a lot of pieces that come together that benefit from each other. Side effects. Okay? And as I say in the video, Apple's a perfect example of that. Their personal computer market share had dwindled to about 1%, and then they came up with the iPod, and people started looking at their personal computers again. When they started buying Apple's iPod, they thought, let's take a look at their personal computers, and their personal computer sales took off. Side effects. Side effects can be bad. People might trade down to buy products that have lower profit margins if you offer those products. And so we'll do some cash flows that show some good side effects and some bad side effects. So for example, if you have one product in the marketplace and it is a premium product, a lot of features, really high price, and your marketing team sees that there is a hole in your product line, that there is a tremendous opportunity to sell a lower level product at a cheaper price, and you could pick up a lot of new customers. Some of those new customers that you pick up might have bought the higher margin item, the higher profit margin item, the higher price point item, but then decide, hey, there's a cheaper product out there that they offer, I'm going to go for that. And that cheaper product might not have a profit margin that's as high. So that's the kind of analysis that you have to do. And again, as you've heard me say all semester long, business is very uncertain. Okay? You operate in an uncertain environment, and you make your best effort, you make a reasonable, logical case for your approach. You gather as much data as you can, but it's not science. It's very uncertain. But your marketing team does their work, and they determine that at the end of the day, if you offer that full product line, a low price point product, a mid price point product, and a high price point product, you might come out ahead. And so you go ahead and make that decision to do it. So some of the people might trade down from a high price point product to a low price point product. So sometimes good, sometimes bad. So you include positive cash flow for good side effects, and you subtract negative cash flow from the bad side effects when you do a capital budgeting analysis. And we'll do a problem or two that includes good side effects of that. All right, sunk costs. What are two examples of sunk costs, and how do you handle them in a capital budgeting analysis? So sunk costs are costs that you will not recover if you decide not to move forward with a project. So these are not incremental cash flows. So again, as I mentioned, one of the first things you have to do in the process of doing a capital budgeting analysis is what cash flows do we include and what cash flows do we exclude. And sunk costs are excluded because you will not get your money back if you decide to move ahead with the project. Okay? Examples of sunk costs include marketing research and a prototype. Okay, so if you spend money on a prototype, or if you spend money on marketing research, and I highly encourage you, if you're thinking about doing a business or buying an existing business, to spend, I've told you before, I think you ought to spend money on a CPA, a good accountant, get advice from a good accountant. Okay, don't look it up on the internet. Spend money on a good attorney. Don't use LegalZoom, okay, to do these things. Okay, so it's going to cost you a little bit more, but it's, in my opinion, it's well worth it. Okay, and I think you ought to spend money on some marketing research. Again, no guarantees, but you'd rather spend a little bit of money on the front end and not get surprised. Okay, so spend a little bit of money on marketing research. If you decide not to do the project, you built that prototype, you gonna get your money back? No, it's a sunk cost. The decision you're trying to make is, do we move forward from this point to do the project? Just because you've built the prototype, or done the marketing research, or paid the accountant and the lawyer doesn't mean you have to go forward with the project. If you determine that the project is not feasible, you'd rather have spent the $5,000 on the attorney and the accountant, or $8,000 or $10,000 in the marketing research, than to lose $100,000 on the project. Okay? So these are sunk costs, and you don't include them. It's tempting and sometimes confusing to look at these costs and say, yeah, that's a cost of doing business, I should put it in there. They're not incremental cash flows, you don't put them in there. All right. All right. How are financing costs handled in a capital budgeting analysis? And why are they handled this way? Financing costs. All right, so what I'm talking about in particular is interest. Interest, okay? And the answer is you ignore interest costs in a capital budgeting analysis. You ignore interest costs. Now, there are two ways that you prepare your financial data. One way, in one approach, you include your interest costs if you're going to finance using debt, some debt, okay? Because you want to know, you want a forecast of what your financial statements are going to look like. You want to know what to expect going forward. And you're going to have some interest costs, so you include those interest costs. But when you're doing a capital budgeting analysis, that's for a different purpose, and you do not include your interest costs. And there are two reasons. The first is the cost, and this is the primary reason. The cost of debt is included in your discount rate. We're going to get into that in Chapter 11. But this discount rate here includes your cost of debt. So if you have your cost of debt here, when you're discounting or finding the present value, and you subtract your cost of debt here in your cash flows, you're double counting your cost of debt. You don't want to do that. That's not accurate. Okay? The second thing is, the second reason why you exclude interest is that you want to create a level playing field. Everyone's looking at projects, and everyone's going to decide, make a different decision about how to finance. Mr. Shepard doesn't like debt. That's what's right for him, and he would share with you that that is a valuable lesson that he's learned, and he thinks that's important. Other people would take the other side of that argument and say, I have used debt and it's helped me tremendously. And, you know, you'd have to decide for yourself, you'd have to listen to both cases. To neutralize the argument, you simply ignore interest costs in the analysis. Okay? So, the main reason you ignore interest costs is because it's here when you're doing your cash flows. You don't want it here too. That's double counting. Okay? All right. So, these problems are pretty comprehensive problems. There's a lot of data in them. And I can tell you from the exams that I've put together that, again, one of the first things you have to do is decide what you're going to include in cash flows and what you're not. So let's look at an example of what to include in cash flows and what to exclude. So Pfizer Inc. is considering plans to set up a new manufacturing plant. They spent $500,000 on a study of the project. The study indicates that they will need land, a building, equipment, and startup working capital like inventory, receivables, and salaries. They spent $300,000 on a prototype. They purchased the land 6 years ago for $7 million, but they've never used it. A similar property recently appraised at $8.1 million. The plant building will cost $15 million. Pre-construction site improvement will run $750,000. They will need raw materials, labor, and will have to fund receivables, all totaling $500,000. what should they use as the total cash outflow at the beginning of the project? And using our calculators, that would be CF0, cash flow at time 0. So our first order of business is to determine what CF0 is going to be. All right, and that's just basically it's a budgeting list. It's a checklist of what are our costs going to be. So we've got $8.1 million for the land. Okay, we own the land, but I told you there's an opportunity cost there, and I told you that you have to use the market value of that opportunity cost. So it's not free, and it's not the cost that they have in it of $7 million. It's the missed opportunity cost from selling land of $8.1 million. Okay. Then the property, plant, and equipment, $15 million is an outflow. $750,000 to improve the site is an additional outflow. $500,000 in working capital is an additional outflow. In total, you've got $24.45 million. All right, so work through that list. Make sure I did the math right.
Dr. Reed,
Yep.
why would you use the other, like the similar property instead of like what you purchased it for?
That's you're using that as an indication of what your property's worth.
Oh, okay, so you don't.
You're not using that
you don't
similar
use this-
property. No.
You don't use this.
You're
okay.
looking at that similar property as your opportunity cost.
Okay. Okay.
Yeah. Okay. So what are we ignoring? We're ignoring the $500,000 that we spent on the feasibility study, and we're ignoring the $300,000 that we spent on the prototype, and we're ignoring the $7 million. We're not using the $7 million original land cost. So those are the kinds of adjustments you have to make in the analysis and on the exam. And yes, there'll be a question just like this, where I'll list a number of items and ask you the question, what is your outflow? All right, so that gets us through homework 1. Let's move over to homework 2. So, as I've said before, you got to spend money to make money. And we just spent our money. That's our CF0, that's our outflow. All right, now what do we hope to get from that outflow? Why did we make that expenditure? What do we hope to get back? And that is operating cash flow. Okay, that's why we spent the money, in order to generate operating cash flow. Okay, so what is the formula for operating cash flow? So operating cash flow, the formula is EBIT plus depreciation minus taxes. Operating cash flow. Okay. EBIT plus depreciation minus taxes. All right. How do you compute the tax expense to get operating cash flow? The tax is part of it. We went over this in chapter 2. You take your EBIT and you multiply it by your average tax rate. Now the line item after EBIT or operating income on the income statement is interest expense. Interest expense is not an operating cost, it's a financing cost. Okay? And it's deductible, and it impacts your taxable income. That's why we ignore it. We are ignoring the tax effect of interest. So you take your EBIT and multiply it by your average tax rate. All right. How do you compute net capital spending for an ongoing business and for a new business. There are two different ways of doing it. So the first way is for an ongoing business. Remember that some of the money you make in a business, you have to reinvest to maintain that business or to grow that business. And you have to reinvest in property, plant, and equipment, and that's capital spending. And then you have to reinvest in working capital. Okay? All right, so net capital spending is equal to ending net fixed assets on your income statement. I'm sorry, on your balance sheet, excuse me, on your balance sheet. So your ending net fixed assets minus your beginning net fixed assets. So you look at net fixed assets at the end of the year and subtract out net fixed assets at the beginning of the year. And then you add your depreciation expense. And that gives you an idea of how much money the business spent on property, plant, and equipment. Okay? Now you're approaching this kind of as an outsider. If you're an insider, and you're involved in the decisions to spend money, you have access to accounting information. You can compute this information directly, which is the second way you look at it. For a new business, how do you determine how much money you're going to spend? You develop a capital budget. Okay? So you get with the people who are involved in the project and you say, what do we need? What do we need and how much is it going to cost? And you put together your grocery list. Okay? All right. So that's net capital spending. And if net capital spending is a positive number, then that's the amount of money that's going to be subtracted from your operating cash flow. Okay? So the formula that you see in the book and the videos is operating cash flow plus or minus the amount spent on net capital spending. Because if you're selling assets, not buying assets, most growing businesses are buying assets. And if you're buying assets, that's a negative for cash flow. Hopefully it's a positive for the business. You spend money to make money. Don't confuse a negative for cash flow with a negative for business. They're not the same. Okay? Some people get all caught up, oh, they're spending money left and right. If they're generating money on what they're spending, it's okay to do that. That's why you're in business. You've got to spend some money to make some money. And then plus or minus the change in net working capital. So that's working capital. And again, it's plus or minus. How is it going to affect your operating cash flow? Are you going to be selling, are you going to be collecting your receivables? Or are you going to have to fund new receivables? Hopefully this is a negative number. Hopefully you've got new receivables. And it's going to cost you some money to finance those receivables. Okay? So what are we trying to get at? How much money will the business generate each year? That's what we're trying to get at. All right. How do you compute the change in non-cash working capital? So we know what working capital is.